Hello, welcome to the first webinar on the revised CDFI certification application. Today, we're going to provide an overview of the revised application. We also plan to hold more webinars in January to discuss the specific application questions and AMIS. Today, Jeff Merkowitz, Senior Advisor to the Director of the CDFI Fund, and I, Michelle Dickens, Program Manager for the Office of Certification, Policy, and Evaluation, will be the presenters. Please send any questions you may have via AMIS. The information on how to do that is on the last slide. With the opening of the application, the certification and financial strategies and research units have staff dedicated to reviewing and answering your questions. During this presentation, we will outline the requirements of CDFI certification as reflected in the revised CDFI certification application and related tools, the Annual Certification and Data Collection Report, or ACR, and the Abbreviated Transaction Level Report, or TLR. The CDFI Fund has been developing revisions to the CDFI certification for several years now, and these final revised documents come after OMB published the proposed revisions to the application in November 2022 for the final round of public comments by the Office of Management and Budget. Separately, at around the same time, OMB released our proposed modification to the revised ACR and abbreviated TLR for a final round of public comment. The ACR and TLR are information collection tools related to the CDFI certification application that are used to maintain a CDFI certification and gather data. After conducting a thorough review of all comments received, the CDFI Fund made further revisions to the CDFI certification application, the ACR, and the abbreviated TLR to provide greater transparency and clarity around the criteria that entities must meet to obtain, maintain, and measure CDFI certification, which is what we'll be going over today. As a preview, during this presentation, we will provide background on the CDFI Fund and Community Development Financial Institutions, discuss CDFI certification and our review of the certification policy, and show a brief high-level overview of the revised CDFI certification application, followed by a more detailed section-by-section discussion of the application. In a separate webinar earlier next year, we will go over the revised transaction level report and the annual certification report.
To begin with, the CDFI Fund's mission is to expand economic opportunity for underserved people and communities by supporting the growth and capacity of a national network of community development lenders, investors, and financial service providers. And our vision is an America in which all people and communities have access to the investment capital and financial services they need to prosper. While initially authorized under the Regal Community Development and Regulatory Improvement Act of 1994, as seen here, the CDFI Fund manages 9 separate programs authorized through 6 different statutes, which I won't read out, but are listed here. What all of these statutes and programs do is allow the CDFI Fund to certify entities that want to be recognized as CDFIs and to provide resources to those entities, along with other community development mission-driven organizations. So what is a CDFI? For anyone viewing who is not already familiar, CDFIs are community-based financing entities that expand economic opportunity in low-income communities and provide financial products and services to individuals and businesses often underserved by traditional financial institutions. They include banks, credit unions, loan funds, and venture capital funds, And they do all the things most mainstream financial institutions do. They help families finance their first homes, support small and startup businesses, establish and rebuild credit histories, and invest in local health, education, and community facilities, as well as provide financial services and training. Moving on to CDFI certification and CDFI fund review of certification policy.
As mentioned, the CDFI fund is responsible for certifying CDFIs, which is a requirement for participation in most of our programs. For the purpose of certification, the CDFI fund verifies that an organization meets the certification requirements through a series of validations and tests in the certification application, which is a standardized application form submitted through our Awards Management Information System, or AMIS. Once certified, CDFIs also are required to confirm on an annual basis that they continue to meet certification requirements, as well as report on their yearly lending and investment activity through submission of the ACR. To become a certified CDFI, an organization must demonstrate through the application that it meets a number of statutory, regulatory, and administrative requirements. First, it must be a legal entity. It must have a primary mission of promoting community development. It must be a financing entity that primarily serves one or more target markets and provide development services in conjunction with its financing activities. It must maintain accountability to its defined target market, and it must be a non-government entity, and with the exception of tribal governments, not under the control of any government entity. Over the past 2 decades, CDFIs have evolved in scope, scale, and sophistication. The number of certified CDFIs have grown from 196 in 1997, when the first certifications were issued, to nearly 1,500 today. And the total assets held by CDFIs have grown to more than $300 billion. CDFI certification has become a brand in itself, and a qualifier not just for CDFI fund resources, but also for other federal, state, and local governments, as well as private sector programs and benefits. And the types of CDFI financial products and financial services have expanded, as has the use of technology to increase market reach.
Given these changes to the industry and to the significance of the CDFI certification, the CDFI Fund undertook its review of the standards for certification and the certification application that reflects those standards to ensure they remain appropriate to the evolving nature of CDFIs and sufficiently protect government resources. Our review considered comments received based on multiple opportunities for public input, beginning with a request for information published in January 2017 that sought comments on the then current CDFI certification policies and procedures. We received 28 comment letters in response to that RFI, and after thoroughly reviewing those comments, developed an initial draft of a revised certification application, ACR, and TLR that were released in May 2020. Stakeholders responded to that publication with 55 comment letters, which we then spent nearly 2 years reviewing and adjudicating before making additional revisions to the application and sending to OMB for publication, and one more round of comments in November 2022. OMB also published the revised ACR and abbreviated TLR for a final round of comments in December 2022. This time, we received a total of 275 letters with comments on the application and an additional 40 letters on the ACR and abbreviated TLR. Again, the CDFI Fund thoroughly reviewed and considered all of the comments we received and made further substantive revisions to the certification application, the ACR, and the abbreviated TLR before submitting them for approval to OMB.
The next two slides will provide a brief description of each section of this CDFI certification application. They will provide useful information for each section of the application at a glance. So for now, we'll quickly move past these slides to save time and discuss the application in greater detail section by section. During this section of the presentation, we will provide a general overview of each section of the final revised application. However, there is much more information and guidance available in the application and on our website, and we recommend that reviewers read the application and any guidance carefully. We also will be posting additional detailed application guidance once AMIS officially opens to accept new CDFI certification submissions on December the 20th. Before the full application can be submitted, we've added a new eligibility determination section that will allow potential applicants to indicate whether certain activities or practices that are not already specifically listed as acceptable would meet the standards for CDFI certification or might otherwise be disqualifying. Previously, applicants typically had to complete and submit the application or a separate request in AMIS, and oftentimes engage in a lengthy back and forth with the CDFI fund before the CDFI fund could make a determination as to whether some parts of an application met our standards or not. Instead of this informal determination process under the revised application, all applicants must now complete a set of questions to determine if they seek to either include any non-pre-qualified financial products or financial services as part of their financing entity and or target market calculations, determine whether certain assets or staff time may either be disregarded or included as part of the financing entity predominance test, designate any non-pre-qualified targeted populations as part of their target market, or use any non-pre-qualified target market assessment methodologies, or request an amendment to the standards for responsible financing practices. If an applicant believes all of its activities meet the certification standards, it will respond to each question to indicate that no CDFI fund consideration is necessary, and then move on to complete and certify the TLR before coming back to complete the remainder of the application. It's important to note that positive eligibility determination on any item submitted in advance of an application does not guarantee that a remainder of the applicant's activities will meet certification standards, or that its application will eventually be approved. After an applicant has determined that it does not need any considerations for eligibility or has already received a response for any considerations by the CDFI fund, and the transaction level data demonstrates that it meets the target market requirement, an applicant is ready to begin completing an application and will begin with the basic information section and provide certain information about the applicant, its affiliates, and or other related entities, and its financial products, financial services that are related to the CDFI certification requirements. Because of the dynamic nature of the application, this information also will help determine the appropriate questions that will display based on an applicant entity's type and other characteristics. Note that much of this information will be auto-populated based on the data from the applicant's AMIS account. but the applicant still should review the information to ensure that it is accurate and complete. Most of the information collected in this section is similar to what was collected on the previous application. However, this section now includes a set of questions on the demographics of the applicant's governing leadership, that is, the governing board or ownership, and of its executive staff. This data is collected for information purposes and has no bearing on the CDFI certification determination, but will help give us a better picture of the CDFI industry. The next section of the application is to confirm that an applicant is a legal entity, which is the basic requirement for CDFI certification. This section of the application has been significantly streamlined, and now, as was recommended by a number of stakeholders, applicants will demonstrate that they meet the test by separately registering with sam.gov and obtain a unique entity identifier. This eliminates the need for most additional documentation, and most of the section will be auto-populated. If any of the pre-populated data fields in AMIS displays inaccurate information, it must be corrected before the submission of an application.
Some of the most important changes to the application come as part of the primary mission test, which has been significantly strengthened to help ensure not only that an applicant has a stated mission of promoting community development, but that its activities align and are consistent with such a mission. For the CDFI fund to make this assessment, applicants will provide information in this section that will allow the CDFI fund to consider whether the activities of the applicant are purposefully directed toward improving the social and/or economic conditions of underserved people and/or residents of economically distressed communities, as is required by CDFI fund regulations. This information will include documentation of the applicant's community development mission, which must have been board approved and in place for at least the 6 full completed months immediately prior to submission of the application, as well as whether the applicant has a community development strategy and whether it meets the CDFI fund's standards for responsible financing practices consistent with a community development mission. As mentioned, in addition to demonstrating a documented mission of promoting community development, applicants are now required to demonstrate that they have a community development strategy. This can be demonstrated either through a board or owner-approved strategic plan that shows evidence of a community development strategy, or if the applicant does not have a strategic plan, through a board or owner-approved narrative describing the community development outcomes the applicant believes will result from the provision of its financial products and financial services, and how those financial products and services lead to those outcomes. Also new to the primary mission test, an applicant now must demonstrate that its financing activities meet a set of standards for responsible financing practices, which will help to ensure that those financing activities are consistent with a community development mission. The application questions reflect principles that a CDFI's financial products should not harm consumers, be affordable, and originated based upon an assessment of whether a borrower is able to pay back a loan and have terms and conditions that are transparent and understandable to the borrower. The standards specify a number of ineligible financing practices, including offering consumer loans that allow for an APR exceeding 36%, as measured by the Military Annual Percentage Rate, or MAPR, if those loans also have an annual default rate over 5%, include a leveraged payment mechanism, have repayment timeframes that exceed 12 months for any such loans of $1,000 or less, if for a period of 12 full months after the issuance of any such loan, The applicant does not waive any upfront fees for any refinance or new loan issued to the same borrower. If any fees associated with such installment loans are not spread evenly over the life of the loan or pro rata refundable in the event of early repayment, including through a refinance, or if all payments on any such installment loans are not substantially equal and do not amortize smoothly to a zero balance by the end of the loan term. So just to be clear, lending above 36% MAPR for consumer loans is not by itself automatically disqualifying, but would be if in combination with any of the additional listed practices or characteristics associated with those loans. We should also be clear that while the standard uses the MAPR methodology, applicants and CDFIs are not required to calculate, disclose, or report the MAPR for their consumer loans unless otherwise required to do so. For certification purposes, applicants are required only to attest as to whether or not any of their consumer loans allow for a rate in excess of 36% MAPR. Continuing. Also disqualifying is originating or otherwise offering loans that exceed interest limits that apply to non-depository institutions in the state where the borrower resides. This is intended to prevent so-called rent-a-bank lending that has been used to evade local interest rate limits. There are also a number of ineligible practices focused on mortgage lending. Specifically, single-family, owner-occupied residential mortgage loan products that are secured by a non-subordinate lien. With some exceptions that are spelled out more specifically in the application and guidance, an applicant would be found ineligible for certification if it fails to verify the income or assets of the borrower of any such mortgage loan product, offers mortgages that include negative amortization or interest-only payments, charges upfront points and fees to the consumer that exceed 3% or the qualified mortgage limits for smaller loans, or underwrites any such mortgages at less than the maximum rate in the first 5 years. Again, these standards apply only to owner-occupied residential mortgages that are secured by a non-subordinate lien, meaning they don't apply to mortgages that are in a second or lower position. And also to repeat, there are other exceptions. You should review these carefully in the application and guidance. But just as an example, an interest-only bridge loan or one used to help avoid foreclosure would be considered acceptable for the purposes of certification. Continuing with the ineligible practices, also prohibited for the purposes of certification are selling charged-off consumer or small business debt to debt buyers. For FDIC-insured applicants, a current CRA rating below satisfactory. And for any applicant with equity investment financial products, using those products to gain control over an investee or leveraging for its own benefit the assets of any of its active equity investees. In addition to practices that are automatically disqualifying, the standards for responsible financing include some practices that may disqualify an applicant from certification, but for which the standards provide some flexibility and allow an applicant to offer an explanation in the application of how the applicant's engagement in the practice is consistent with a community development mission. For example, for the purposes of CDFI certification, applicants' underwriting standards should include an evaluation of a mortgage, consumer, and/or small business borrower's ability to pay back a loan. Applicants that do not originate all such loans based upon an assessment of whether the borrower is able to pay back a loan may be determined ineligible for CDFI certification, but will have an opportunity to offer a narrative as part of their response to the question, explaining how the absence of such an assessment serves a community development purpose, which the CDFI fund will evaluate based on the extent to which the explanation is consistent with the principles of community development financing referenced earlier. Additional practices that are generally considered inconsistent with a community development mission, but for which an applicant may have to demonstrate that it meets additional conditions and/or will have an opportunity to justify in the application, include offering small business loans that allow for an APR exceeding 36%. Note that for small business loans, that the standard TILA methodology for calculating APR may be used. Also, offering certain mortgages with balloon payments, or unless they are provided through a government program, mortgages that carry an original maximum term longer than 30 years, and charging excessive overdraft or non-sufficient funds fees or other practices that are related to those fees that are harmful. I want to come back just very briefly to the questions that cover mortgage lending and emphasize that users should pay particular attention to the scope of the different questions, since although they are very similar, there are some important differences. The scopes are spelled out in the application and guidance, so I won't get into all the detail here. But one important difference is that the question on evaluating a mortgage borrower's ability to pay back a loan includes subordinate loans, while as noted previously, other questions apply only to non-subordinate mortgages. One final practice to highlight: the application includes questions for applicants that offer small business loan products, and whether they disclose in writing the periodic payment due, the total amount to be repaid over the life of the loan, and the APR of the loan. We are delaying implementation of the responsible financing standards related to these disclosures in order to give additional time for lenders to make any necessary changes to their software systems. So for now, these questions are for information purposes, but beginning January 1, 2026, new applicants will be required to attest to making such disclosures in order to become certified, while CDFIs that are already certified at that point will be required to do so in their ACR no later than October 1st, 2026, in order to maintain their certification. It is important to note that the primary mission test, and especially the standards for responsible financing practices, must be met by not just the applicant, but by the parent entity of the applicant, as well as any of the applicant's affiliates that provide financial products and/or financial services. It was previously the case that this type of collective review applied to all depository institution applicants, but now, just for the primary mission test, it will apply to all applicants. Although applicants will not be required to demonstrate that their parent and affiliate entities have a community development strategy or have a mission that explicitly promotes community development, they will have to demonstrate through their responses to the questions in the application that they have a mission that supports and/or is consistent with that of the applicants in order to meet the test. They also will have to demonstrate that these entities meet the standards for responsible financing practices. Finally, as was indicated previously, in order to allow for some flexibility and to avoid unintended consequences, if an applicant is engaging or seeks to engage in any financing activity that does not currently meet the standards for responsible financing practices of the primary mission test, but that it believes serves a community development purpose and is consistent with a community development mission, the applicant may seek amendment to the standards that allows for that activity. To be clear, however, the CDFI fund will not approve individual exceptions to the primary mission test or make case-by-case determinations. If the CDFI fund believes a specific activity under certain circumstances is consistent with a community development mission, we will amend the standards, and that amendment will be made available to all CDFIs and future applicants. If, on the other hand, the CDFI fund denies the request to amend the standards, the applicant will be prohibited from engaging in the practice to remain eligible for CDFI certification.
The next section of the application measures an applicant's ability to meet the regulatory requirement that a CDFI shall be an entity whose predominant business activity is the provision and arm's length transactions of financial products and/or financial services. Insured depository institutions, depository institution holding companies, and credit unions with federal insurance are deemed to automatically meet the financing entity test, but other applicants must demonstrate that the predominance of both their assets and staff time use are derived from or dedicated to the provision of financial products and/or financial services, that they have been engaged in the provision of allowable arm's length and on-balance sheet financial products and/or financial services as their predominant business activity for at least one full fiscal year, or in the case of a spinoff entity, that it has begun closing arm's length on-balance sheet financial products and/or has delivered financial services, and that they will have or will have access to sufficient capital to close at least one new financial product transaction during the next upcoming 3 months from the date the application is submitted. The revised application includes new fields that assist applicants in allocating asset and staff time use between those dedicated to financing activities and those dedicated to other activities, and to calculate whether or not they meet the financing entity requirements. We also want to highlight that while per regulation, development services may not be counted towards an eligible financing activity, applicants may be able to disregard staff time dedicated to the provision of such activities in the calculations to determine predominance.
The next section of the application measures an applicant's service to a target market, which may be a geographic investment area that meets at least one economic distress criteria based on poverty, income, unemployment, or population decline. A low-income targeted population, defined as individuals with a median family income not greater than 80% of the area or state median family income, and/or an other targeted population, that is, groups with a demonstrated lack of access to capital and/or financial products or services. To meet the certification requirements, an applicant generally must demonstrate that it directs at least 60% of both the number and dollar volume of its financial products to an eligible target market. To be clear, applicants can serve more than one target market component, and the non-duplicative percentage of financial products delivered to those different target market components can be combined to meet the target market benchmarks. The revised application also implements a new financial services option for depository institution applicants that falls short of the financial products threshold to meet the target market test. Under this option, a depository institution that has directed less than 60%, but still at least 50% of either the dollar volume or the total number of its financial products to one or more eligible target markets can still meet the target market test if at least 60% of its total unique depository account holders are members of one or more eligible target market component, and it delivers at least 60% of either the number or dollar volume of its financial products and at least 50% of the other to one or more eligible target markets. There are additional target market flexibilities reflected in the new application as well. For example, once an entity becomes certified or recertified under the revised application, If it fails to meet the target market benchmark over its most recently completed fiscal year, it will be able to remain certified if it has met the benchmark over the 3-year period through its most recently completed fiscal year. There is more explanation on this in the FAQ, but the CDFI fund will measure this using a CDFI's ACR data, and the option will be phased in, which means it won't kick in fully until an entity has been certified under the revised application and submitted at least 2 ACRs. Another flexibility is the elimination of the requirement to submit a target market map in most situations. Specifically, if an applicant's target market is made up of pre-qualified investment areas or a pre-qualified targeted population. A pre-qualified investment area consists of those census tracts that the CDFI fund has determined meet statutory economic distress criteria. Applicants serving these qualifying census tracts and/or one or more of the pre-qualified targeted populations, that is, an LITP or one of the listed OTPs, are not required to develop a map of their own, of their target market, and will be able to count a financial product to members of those target markets, wherever they reside, toward their target market thresholds. That also means that simply expanding the geographic scope that a CDFI serves no longer will require a target market modification, and such a modification would be required only if a CDFI seeks to serve a new target market type for which it hasn't been approved. Applicants serving a customized investment area or that request approval of a new OTP still will be required to submit related maps for those target markets. Speaking of customized investment areas, these are specially designated geographic areas that combine a mix of contiguous geographic units of a single type that meet the criteria of economic distress with others that do not, but that as a whole meet the distress criteria for an investment area target market, as validated by the CDFI Information Mapping System, or CIMS. The geographic units may be census tracts or non-metro counties or parishes, but must be contiguous, and more than 85% of the population of the customized investment area as a whole must be in qualified geographic units, that is, those that individually meet the investment area distress criteria. Only the financial products and/or financial services activity that falls within the boundaries of the designated customized investment area will count as being within a target market. However, a new condition for counting the financing activity in the non-qualifying census tracts of a customized investment area as within a target market is that at least 85% of an applicant's total financing activity in the customized investment area must be within the individually qualifying census tracts of that customized investment area. This standard will apply to countywide and parish-wide investment areas as well, which by regulation can only be in non-metro areas. However, recognizing that rural lenders serving a non-metro customized investment area, county, or parish may need additional time to reach this threshold, until October 1, 2026, the standard for applicants serving such areas will be that they must direct at least 75% of their financing activity within the individually qualifying census tracts of the respective non-metro geography for activity in the non-qualifying tracts of that non-metro geography to count toward the 60% target market benchmark. Beginning October 1, 2026, all applicants and CDFIs, whether operating in a metro or non-metro geography, will need to meet the 85% standard highlighted above. The revised application also includes the newly designated pre-qualified other targeted populations of Filipinos, Vietnamese, and persons with disabilities. There is also a major difference in how applicants must compile and submit their target market data in the revised application. Target market data that was previously collected in the aggregate will now be collected by transaction in the TLR and abbreviated TLR, which will both allow for greater verification of an applicant's target market activity and provide a more complete picture of the impact of the industry as a whole. As part of our efforts to increase transparency and reduce burden, whereas previously applicants had to describe and seek approval for each target market assessment methodology they used to confirm financing activity to their identified target markets, the revised application includes the ability for applicants to select from a set of pre-approved target market assessment methodologies that applicants can use and rely upon. As has always been the case, applicants are still required to use only those target market assessment methodologies that have been specifically approved by the CDFI fund when compiling target market financial products, depository accounts, board members, and/or credit union members meet the target market criteria. If an applicant seeks to use a methodology other than one of the list of pre-approved methodologies, it must request a determination from the CDFI fund in advance of completing its application for submission. The list of pre-approved methodologies is available on the CDFI fund's website and will be updated as appropriate.
The next section of the application covers development services. The CDFI fund statute mandates that the CDFI must provide development services in conjunction with equity investment or loans directly or through a subsidiary or affiliate. And our regulations states that the CDFI directly through an affiliate or through a contract with another provider must have a track record of providing development services in conjunction with its financial products and/or financial services. The requirement of this section of the application have not changed significantly. Though our previous efforts at increasing transparency around the standards to meet this test seem to have been highlighted areas that the standards may not have been fully understood. We have continued those efforts to increase transparency in the revised application and have further refined our language to make it clear what is an eligible development service and what is not. As stated in the application, an eligible development service is a structured training, counseling, or technical assistance service that promotes access to and/or success with an entity's financial product and financial services. It is also separate and distinct from routine customer service, marketing, or origination activity. To meet the requirement, the CDFI certification applicants must demonstrate that at least one development service is regularly offered to their clients and is provided at least once annually, demonstrate that development services provided via contract with a third-party entity are routinely reviewed and monitored, and clearly identify how any development services prepare or assist current or potential borrowers or investees to use at least one of the applicant's financial products or financial services. There is one specific issue that we want to address, given the number of questions that we've received, that has to do with development service delivered to youth. Depository institution applicants are allowed to identify financial education as a development service if it promotes the opening of a depository account or building savings in an account with the applicant. And this applies to financial education for youth as well. Although other financial education for youth under 18 years old does not fall under the definition of a development service, the CDFI fund allows financial assistance award funds to be used to provide a broader range of such financial education. The next section of the application tests whether an applicant meets the statutory requirement to maintain accountability to its target market. Individual board members can be determined to be accountable to a target market on the basis of any of the sources of accountability listed in this table. To demonstrate accountability to an investment area, an individual can be a resident of a qualified census tract, the owner of a small business primarily located in a qualified census tract or tracts, or the owner of a small business that principally employs and/or principally provides goods and services to residents of the qualified census tracts. An elected official primarily representing residents of qualified census tracts, a staff member of a non-affiliated third-party community development mission-driven organization that primarily provides services to the residents of qualified census tracts, or the applicant serving investment areas located in native geographies are enrolled in a federally recognized tribe. To demonstrate accountability to a low-income targeted population, an individual can be a low-income individual themselves, or a staff member of a non-affiliated third-party community development mission-driven organization that primarily provides services to low-income people. Finally, to demonstrate accountability to an other targeted population, an individual typically must be a member of the targeted population, with some exceptions for specific OTPs. For applicants serving other CDFIs as their OTP, the board member can be a staff member of a certified CDFI. And for applicants serving people with disabilities, the board member can be a staff member of a non-affiliated third-party community development mission-driven organization that primarily provides services to people with disabilities, or a family member of a person with disabilities. Family members include those related by blood, including half-siblings, adoption, or marriage. At the organization level, the revised application places greater emphasis on governing boards as a source of decision-making and demonstrating accountability to a target market, but provides applicants, in part depending on institution type, with 4 different options. The first, for any entity type, is through a governing board only in which at least one governing board member is accountable to each proposed target market type, and at least 33% of the governing board is accountable to the overall proposed target markets. All applicants also may demonstrate accountability through a governing board supplemented by an advisory board using this option. At least 20% of the governing board members must be accountable to the overall proposed target market. At least one advisory board member must be accountable to each proposed target market type. At least 60% of the advisory board must be accountable to the overall proposed target markets. At least one governing board member must also be a member of the advisory board, and the applicant must have adopted an advisory board policy. Credit unions also have the option of demonstrating accountability through an advisory board supplemented by their membership if at least 33% of the credit union's members are determined to meet at least one target market type in the overall proposed target market. At least one advisory board member is accountable to each proposed target market type. At least 60% of the advisory board is accountable to the overall proposed target market. At least one governing board member is also a member of the advisory board, and the applicant has adopted an advisory board policy. Depository institution holding companies, insured depository institutions, and entities without formal governing boards, on the other hand, all have the option to demonstrate accountability through an advisory board only, though, as with other advisory board options, still with a governing board connection if at least one advisory board member is accountable to each proposed target market type, at least 80% of the advisory board is accountable to the overall proposed target market, at least one governing board member, governing leadership member of the applicant entity is also a member of the advisory board, and the applicant has also adopted an advisory board policy. Note that these options for demonstrating accountability reflects changes that have significant implications that benefit applicants that seek to serve multiple target markets or a national investment area. Previous geographic requirements on accountable board members have been an impediment to CDFI expansion and the ability to serve an approved national target market. Now, however, under each of the options, board member sources of accountability are based on a target market type separate from the geography of the target market. Additionally, for applicants with multiple target markets, the revised certification application allows for target market representatives to meet accountability standards collectively, eliminating a lot of burden associated with the previous application, which required each proposed target market component to meet accountability standards separately. Finally, there are also some limitation on board members with certain financial interests in the CDFI certification applicant, including board members who are or who have family members who are employees, principals, or partial owners of the applicant, that would prevent them from being identified in the application as accountable to any of the target markets components. However, the revised application does not. As has been proposed, disallow board members who receive compensation for their board service or those who have an active financial product with the applicant from potentially being accountable to the target market. Instead, applicants must have a policy requiring any board member with an active financial product to recuse themselves from decision-making that may involve their financial product. The final section of the application for CDFI certification purpose is to confirm that applicant is, as required by statute, a non-government entity. There are no significant changes in the application to this section, which proposes a binary questions to identify issues or circumstances that may prevent an entity from meeting this criteria.
For applicants that also want to be designated as a Native American CDFI, there is one additional section of the application. There are two requirements to receive this designation, namely that the applicant directs at least 50% of its financial products to one or more Native communities and maintains accountability to a Native community. The CDFI fund will determine whether at least 50% of an applicant's financial products are directed to Native communities based on information submitted by the applicant in its abbreviated TLR. To measure accountability to a Native community, meanwhile, the options for doing so and the type of information collected are very much along the same lines as those in the general accountability section of the application, but with the focus on Native communities instead of the applicant's target markets.
Finally, the CDFI certification application deployment date set for December 20th, 2023. The CDFI fund will send out an eGov delivery notification once the application is live. At this time, only new organizations can apply for CDFI certification. To support applicants, we will hold more webinars during January 2024, and we will resume the CDFI certification monthly conference calls in February of 2024, where we will be providing information and responding to questions live. As always, the CDFI fund is here to provide information and applicants on the CDFI certification journey. Applicants may reach out to the CDFI fund for additional information regarding the CDFI certification application, the ACR, the TLR, or any AMIS-related issues using the contact information shown on this slide. Again, we thank you for participating on the call today, and we look forward to serving you. Have a great day.